Okay, good morning, everyone. Thank you so much for joining us for today's free webinar, Equity Crowdfunding. Is it a good funding option for your startup? With Jerry Stengel from VentureNear. My name is Erica Malsberg, and I'm the Chief Marketing Officer for Early Growth Financial Services, and I'll be your moderator today. This presentation is going to run about 45 minutes or so. If you have questions as we go along, please feel free to just jump right in and ask them. You can do so by just entering them into the chat field. No need to just sit and raise your hand, just enter them right in. You can also tweet them to us at earlygrowthfs with the hashtag #EquityCrowdfunding. We will take questions as they come, or we'll wait until the end for a Q&A. We'll also be providing our contact information at the end of this presentation. So if you have any specific questions that you didn't feel like asking today, or any questions that you don't feel you got a sufficient answer to, please feel free to follow up with us. We'll also be sending out a follow-up email tomorrow that's going to have a link to the deck and the recording. Before I introduce Jerry today, I just want to say a few quick words about Early Growth. We are an outsourced financial services firm that provides day-to-day accounting, CFO, tax, and valuation services and support for small to mid-sized companies. We currently have a footprint in 9 markets from Silicon Valley to New York City, and we support 10 to 15% of the venture-backed companies in the United States, with an impressive client list that includes companies such as TechShop, Indiegogo, Zendesk, Clout, RocketSpace, OpenERP, and over 500 plus more companies nationwide. Okay, so enough of that nonsense. Moving on to the more important stuff, it's my pleasure to introduce today our presenter, Jerry Stengel. Jerry is founder and president of VentureNear, a content marketing research, and education company that helps companies reach small businesses. As a writer, author of Forget the Glass Ceiling, Building Your Business Without One, and Stand Out in the Crowd, How Women and Men Benefit from Equity Crowdfunding, and a Forbes contributor writing about the success factor of women. She's also an entrepreneur, writing about the success factor of women entrepreneurs, and she's a QuickBooks contributor writing about finance. She's also a consultant, a speaker, and a teacher at Kauffman Fast Track Facilitator and former adjunct professor at the New School. Jerry has helped thousands of entrepreneurs take their vision to reality, develop their business plan, and learn the strategies and tactics they need to grow their businesses. So good morning, or rather, I guess, good afternoon, and welcome to you, Jerry. Thanks so much for joining us today.
Delighted to be here, Erica. So nice for having me. And I'm going to just dive right in and get going. I am going to pause periodically through the presentation so that you can ask questions and get a more timely response. So at the beginning of this year, I sort of embarked on a journey to find out why women were standing on the sidelines of equity crowdfunding. Here was this new way of raising money, and yet women were not gravitating to it. It had the promise of leveling the playing field, and again, just sitting on the sidelines. So with the help of Dell and law firm Elinoff Grossman and Scholl, I undertook a research project to find out and give examples of women who were successful, as well as find out reasons why women were not undertaking equity crowdfunding. And what I found out was that the lessons learned and the best practices are really equally as applicable to men as they are to women, and I'm going to share them throughout the presentation. So I'm going to start sort of at the beginning of what is equity crowdfunding and when it came into effect, and I'm going to provide some market size information and compare it to venture capital and angel investments. And then, as I said, I'm going to talk a lot about best practices and lessons learned, and also give you the angel investors' perspective as to why they're on equity crowdfunding platforms. So if you're a small business, I don't need to tell you that during the financial crisis, it was harder for small businesses than large businesses to raise money, and that impact is still being felt. So large companies are having an easier time to recover from the financial crisis because they have easier access to funding. At that point in time, there were a group of entrepreneurially spirited people who began to think through ways that new funding streams could become available. And they lobbied and advocated to the SEC and to senators and Congress people, and lo and behold, they were able to get a law passed called the Jumpstart Our Business Startups in 2012, and it was one of the very first times that Democrats and Republicans agreed on something, and they very quickly passed the law. Unfortunately, the SEC took a very long time to roll out the rules and regulations, and they're all not completely rolled out at this point. But in 2013, on September 23rd, Title II was approved. And what Title II of the Jobs Act put into effect was that entrepreneurs, startups, and growth companies could now raise money from accredited investors. And they could do that by marketing their securities. And that was what was new. So since 1933, no one but large publicly held companies could publicly market their securities offerings. So you can now use social media, you can put up a billboard display, you can use email, whatever method it is that you want to drive people to know about your securities offering, you can now do. That's called 506C. 506B is the old way of raising equity crowdfunding. So in the 90s, you could raise capital using online platforms, and you are allowed, in this particular case, because you're doing it privately, to raise money from a limited number of non-accredited investors. And those non-accredited investors are people like you and me. We're not wealthy. We don't have, we're not earning over $200,000, and we don't have $1 million in assets in addition to our home. Now, the big change that everybody has really been waiting for is hopefully going to come in the fall or towards the end of the year, and that's Title III, and that's going to enable everybody to invest in startup companies. And that's really when hopefully there will be an explosion in the size of this new funding opportunity. So why is equity crowdfunding so exciting from both an entrepreneur's perspective and even an angel perspective, but I'll talk about the angel perspective in a couple of minutes. So it centralizes everything on one platform. So everything from your investor document to your non-disclosures to your terms and term sheet can now be put in one place and shared with any potential investor. And you're only sharing it to people, with people that have permission to be in the deal room with you. So these are, it's not open to the general public, so you don't have to worry about, people knowing your secret sauce that you don't want them to know about. So people can ask you questions on these platforms, and that gets shared among all of your potential investors, and that's very efficient. So you don't have to answer the same questions over and over again, and your investors get to learn from each other. You can, in some of the platforms, they will do outreach to investors on your behalf. So some of the platforms are investor broker dealers, and they can do outreach on your behalf and actually match you with potential investors. It's reducing the time that, and this is probably the most exciting thing, it's reducing the amount of time that people spend on raising money. So right now it's still taking about 4 to 6 months for people to raise money on equity crowdfunding platforms, when the average in the offline world is more like 6 to 12 months, and sometimes a year and a half, and sometimes 2 years. Through equity crowdfunding, it's been reduced to 4 to 6 months. And in the report, I tell a story about Hint Water, which is the flavored water. She did a private raise, but on equity crowdfunding platforms, and was able to do it in 10 days. So some people are amazingly successful at this point. So I want to give you some numbers, but before I get into the numbers, any questions from people out in cyberspace?
Not yet. Thanks for taking a pause there. But yeah, folks, feel free as Jerry goes on to enter in your questions. But yeah, we can keep moving ahead. I'm still stuck on the fact that she completed her raise in 10 days. That's amazing.
Uh, and if you knew Kara Golden, you would know that she is a ball of fire. So it would be no surprise to you that she was able to do that.
That's great. That's great.
It's awesome.
Great.
So I want to put the size of the crowdfunding market in perspective. Venture capital is a $48 billion market on an annual basis versus angel investments is $24 billion. Crowdfunding really is just a blip. It's maybe 2 or 3% of the market, 2%. It's only a $500 million right now. So it's really in its infancy, and it has a lot of growing up to do. And it's sharing best practices that really is going to help people get comfortable with using equity crowdfunding. So in the real world, the success rate for raising angel investments is about 19%, and that comes from the Center for Venture Research. So from Crowdnetic, which monitors equity crowdfunding, it's 24%. At this point, I don't think there's really a statistical difference between the two numbers because the equity crowdfunding number is so small. So I think they're really about the same, but the point here is that people are being successful in raising equity crowdfunding. The big cities for equity crowdfunding, and this is going to come as no surprise, San Francisco is #1. San Francisco has an amazing entrepreneurial culture. They've been cultivating this, since way back in the 90s and probably even before that. So they have a real track record, and people are comfortable raising money. Both raising money, and people are comfortable investing in companies, and they're comfortable doing it in an innovative way. And New York is #2, and I think you're going to also see in New York that we're going to close the gap pretty quickly. So New York doesn't want to be #2, and we try harder to be #1. And what I find particularly interesting is Austin and Las Vegas are fighting well above their size. So if you looked at their number in terms of overall population, they probably rank in size like market size #35 in that range, and they're in the top 10. So these are highly entrepreneurial marketplaces. So, any questions?
We have one question from Marie. She's saying that she has heard that it's not possible to do equity crowdfunding in all cities across the United States. Is that true? Are there limitations? And do you have to be in the city in which you start a campaign?
So, nope, it is absolutely legal throughout the entire country. So there are many different equity crowdfunding initiatives underway. So there are states that are, because Title III is taking so long to be enacted, some states have started to enact their own legislation. So that would be, I'm going to say, for the unaccredited investor and not the accredited investor. By and large, angel investing is still local, although I think that equity crowdfunding will make it more national and international. But right now, I think it is still, people like to know you, and you know people better when you see them in person. That said, I have interviewed people where their investors came outside of the city where they're located. So, and now I'm forgetting the name of the company, but it was a a craft beer company based in the San Francisco area, where one of her investors who I interviewed, and it was Strike Beer. So if you know Strike Beer in San Francisco, one of her angel investors is based in Houston, and she has other investors that are based throughout the country. But these are um, professional investors and accredited investors.
Okay, great. And so I think you answered this, but just to be clear, Yahua just asked, the cities are based on where the business is based, assuming that investors can be from different states and cities. So that is correct. So those numbers just reflect where the business is, correct?
Correct.
Okay,
Correct.
great. And then one more question before you move on here from Eric, and I'm not sure if you're going to get to this later, so maybe we'll hold it. But he's asking, how do terms differ between equity crowdfunding and angel investors, if any?
So not that I'm aware of. So what will frequently happen is you're going to have a lead angel investor. So in the offline world, you have angel investors, and you'll have a lead investor. That lead investor in many of the platforms sets the terms for the other investors. So it makes it easier for smaller investors to come on board. So the way that equity crowdfunding works is you're not going to have a different term sheet for different investors. You're going to have one investor who leads, and the rest of the investors are going to follow the same terms.
Gotcha. Okay, wonderful. Thank you so much. Yeah, keep going, steam along.
Okay, great. Okay, great.
Sure.
So this is one of my favorite slides, and as luck would have it, or QuickBooks just published an article from me on this topic, and even as I think about it, I actually added another bullet in addition to what I wrote about in the article. So right now, people believe that verifying accreditation is very difficult. In actuality, it's not very difficult. You need any lawyer can do it, accountant, certified investment professional, whether that's your investment advisor or a broker-dealer, can verify accreditation. Many of the crowdfunding platforms will do it for you, and there are plenty of third-party companies that will do it for you as well. Managing investors is complicated. So equity crowdfunding allows you to raise smaller amounts of money from lots of people. And there's a fear that you're going to have a complicated cap table as a result because you're going to have so many investors on it. What frequently happens is you can either roll up all of your investors into one special purpose vehicle, SPV, or break out and roll up the small investors into an SPV. Or you can issue preferred stock, which is non-voting. And your legal counsel can probably also advise you on a couple of other ways as well. Financial reporting. So this to me was fascinating. So again, I'm being advised by firms like Early Growth, as well as law firms that were part of the group that advocated and lobbied to the SEC, meaning Elinoff, Grossman, and Scholl. And really, the SEC understands that or it's not just the SEC, angel investors understand that you don't want the entrepreneur spending all their time on financial reporting. You want them out in the field developing the product and finding customers. So the financial reporting can be on a quarterly basis. You just agree with your angels how often you're going to be reporting, and you can do it in QuickBooks. So that's all you actually need. It doesn't need to be onerous. Raising money on crowdfunding platforms is expensive. Yes, you are going to have to pay crowdfunding and you are going to have to pay for marketing, but you're consolidating your time, make it worth. You can cover that a bit more. Also a reputation that both venture capitalists and angels are dissing crowdfunding, and still pointing that there is still out there from who was told to take off her listing from angel, and where they don't think the quality of the deals are going to be as good. I think time will erase all of that. Venture capitalists are now investing in crowdfunding tune of $240 million. Large corporations are recognizing that both equity and rewards-based crowdfunding is very useful to them in understanding how the marketplace tastes are changing, and also in identifying future companies that they may be buying. And these are companies like Nike and Johnson & Johnson and Merck. So these are large, well-established companies, well-regarded and respected, that are jumping on the crowdfunding bandwagon. There is a perception that if you build it, people will come, and I want to burst that bubble. You have to do a lot of work. You have to do a lot of marketing to your crowd to make them aware that you're raising money. And your crowd may then recommend investing to the people that they know. And Wonder Technologies in particular talked to me about that it wasn't just their immediate connections that they raised money from, but their connections of their connections, or their second and third degree connections were people that they raised money from. Social media outreach will make your campaign go viral, and the rest, as they say, is history. And this is the one that I just added. Social media is sort of background noise when it comes to the effectiveness of your campaign. Things like email, speaking to people by phone and in person are still going to be your most effective ways for closing the deal. For closing the deal. So again, social media is going to drive interest, and people are going to you're doing, but the bulk of the work in closing the deal happens online or in person. So the ugly truth about crowdfunding, and what I didn't mention up front is not only did Dell and Elinoff, Grossman and Scholl fund my report, but I partially funded it by doing a rewards-based crowdfunding campaign. And the reason that I chose to do this is I wanted to understand from firsthand experience what it's like to do a crowdfunding campaign. And there's enough similarity between rewards and equity crowdfunding that I can speak in both cases. And the point that I really want to make about this is that it is hard raising money, period, end of sentence. It is no easier to do it in equity crowdfunding. It's going to be actually more intense because you're doing it over a shorter period of time. But once you're done with it, you're done with it. You can get back to marketing your product and perfecting your product. So should you raise equity crowdfunding? And really the rules right now, I'm going to say, are just like the rules in angel investments. So the laundry list of bullets here are very much like the laundry list you would see in a traditional angel investment. So you want that market size to be hundreds of millions of dollars. And if you're raising venture capital, it's going to be billions of dollars. you want to solve a major pain point. You know, a nice-to-have product isn't going to attract investors. You have to have a defensible competitive advantage, and that could be intellectual property, or it could be first mover advantage, but there has to be something. What's your exit strategy? Do you want to take this to an IPO? Do you think it's more likely that you're going to be acquired by a large corporation? And you have to have a great team. You have to show investors that you're the right person and your team is the right people to bring this product to market. The one caveat I'll say is that when you are raising money from people who know you and trust you, some of the points that I've put up on this list, the bar can be lowered a little bit because they know you and trust you and they believe in you and they believe in your success. So I am talking about equity crowdfunding, but I also want to advise you that really fundraising, there is no one size fits all. You really have to look at all of your options and know which is right for you. And I was having this discussion with a lawyer friend of mine, and the point here is it's actually not just good enough to be a small business lawyer and a small business accountant. You really have to specialize in financing. So a lot of small business lawyers in particular are advising their clients to stay on the sidelines of equity crowdfunding because they don't understand it. If you understand it, then you would know that really the rules of the road are already laid out. There, you know, as I said, you know, there's all this misperception, and part of it is the professionals themselves are the ones that are clouding the potential of equity crowdfunding. So really speak to people that understand early stage investing, and that's both from a legal and accounting vantage point. I love the idea of actually starting with a rewards-based campaign, and I'm going to talk about that in a few minutes. And that rewards campaign can then lead into any one of the three options that are up here, meaning a 506B raise, which is that private crowdfunding raise, a 506C crowdfunding raise, which is public, and rewards also leads into a real world or people, you know, offline angel investing. So choosing an equity crowdfunding platform, in the report I'll give you a laundry list of different equity crowdfunding platforms, and now I'm giving you a very long list of things that you might evaluate the platforms by. I'm going to narrow it down to three that are really the ones that you would start off in the beginning. So what sector are you in? What stage of financing? That might be the first way that you screen the list of equity crowdfunding platforms. The next way that you might take a look at it is, you know, are they full service or self-service? And there isn't a right answer as to which way to do it. It's the right answer for how you want to do it. Maybe you want to, you know, keep costs down and do more of the work yourself. Maybe you want professionals doing everything for you. The decision is really up to you. How do you compensate the platform? And there are many, many different ways of compensating a platform. So you may not want to, for example, have an investor broker because that adds a lot of, that may add costs to the campaign. And it's, you know, that's not an upfront cost, that's only if they're successful. But understand what you want and then evaluate the platforms by that. So I want to give you some success stories. I've put in some links so that you can take a look at both the companies and some of the campaigns that they've run. Digitas really just finished their equity crowdfunding raise, and you'll notice that I'm using a couple of different terms here. Committed versus raised. So committed is by by SEC rules what a company has to say if they've raised money on an equity crowdfunding campaign. So when you see the committed term, it means it may not be the amount that they actually raised, but it is the amount that that investors said that they were going to invest in the company. Sometimes that money doesn't materialize down the road. When you see the term raised, it means that this is what the company actually told me. So, and actually there's a typo here. So Wonder Technologies did raise 800,000. That wasn't committed. That is what they raised. Wonder Technologies is a technology for merchants, small businesses to be able to give gift cards just as large stores do. So it's a sort of universal application. I have other examples of OneVest, which is actually a crowdfunding platform which wanted to walk the walk. So they crowdfunded um, uh, some follow-up investment, and they raised $2 million. And I have a variety of consumer products who have raised money also. So Le Grand Cottage is champagne, and they were able to raise $400,000. Good Clean Love raised $400,000, and one of the things that I particularly like about Good Clean Love is what Wendy Strager had said to me is she had a bad experience, really pretty gun shy, but really needed to raise money for inventory. So she was expanding into Bed Bath & Beyond stores and other large chain drugstores where she needed to have inventory. And she not only found money, she found angel investors who are now advisors to her. And what was very important to her is that she found that she finds investors that were aligned with her particular values. And all of her investors are aligned with her values. One of my favorite things about Smarty Pants is that they were so successful in their first round that they did it again. So equity crowdfunding has worked not once but twice for them. And both Good Clean Love and Smarty Pants are really beyond what I would call the early stage company, and they're more into the growth mode. So as I had mentioned before, I'm a huge fan of using rewards as sort of a stepping stone into equity crowdfunding. And the reason that I like rewards-based crowdfunding so much is that it's debt-free. You don't have to pay interest and give back the money that you've borrowed. It's equity-free, so down the road you don't have to give back money to your investors. They don't own a share in your company. It's great for market research, so your early adopters are happy to provide feedback and help you figure out the flaws in your product. They also are happy to spread the word and talk you up, through social media. And that can provide real social proof that ends up translating into capital. And that capital in the beginning is the fact that they're, underwriting your first production run. Or you can certainly do it even with growth products as well. And this validates to future investors, whether that's offline angel investors or online angel investors or banks, that there is a market for your product. And I'm going to give you a few examples in a moment. And again, it's, you're using social media, so you're engaging your customers in the marketing of your product, and that's terrific. So you're getting marketing as well out of rewards-based crowdfunding. And I've put up a variety of companies that have been successful. So other company machines, they raised $300,000 and then went on to raise $3 million in the real world. thinks they did something that I thought was particularly interesting. They first did a raise on Kickstarter, and they are panties for when women have their periods, and they are leak proof, and they are moisture wicking, and you can wash them out, so they're stain resistant as well. They also, for every panty you buy, give 5 reusable pads to, or not give, but actually sell at a discount through a nonprofit in Africa, pads so that girls can go to school when they have their period. So there is a cause tied to their campaign. And what they didn't realize with the Kickstarter campaign is that they really couldn't highlight that cause aspect of their campaign as much as they wanted to. So they did a Kickstarter campaign followed by an Indiegogo campaign. And then because people still wanted the panties, they put it up on their website, and they continued to sell before they produced the product, and they were able to raise $110,000, and they went on to raise millions of dollars in offline angel investments. I'm going to point out Rue, because they raised money that led to them getting a deal in Whole Foods. So the fact that they drove interest got them distribution in Whole Foods. Real Food Blends went on to do an offline angel investment, and Bumbleroot went on to do an online private raise, so a 506B raise. Okay, so question time?
Sure. First of all, just a reminder to everyone, in case anyone joined us late, we will be sending out the deck. So all those links that Jerry included, you'll be able to click right on them from the deck so that you can check out those companies and their successful campaigns. We have a question from Beth. I think this is going back to one of the companies you mentioned wound up having a really good experience with finding investors who are not investors, but advisors as well. And she's wondering, how did that happen? Like, what's the follow-up that then makes you able to connect with your investors after they've invested so that you can develop a relationship?
So you're going to build a relationship with all of your investors. Um, it's very unlikely that an investor is just going to invest money in you. They're going to want to talk to you. They're going to want you to answer questions. So you're going to build relationships. Many angels in general want to be advisors, and many entrepreneurs want that, those experienced advisors. So, these people may have been entrepreneurs. They may have had very successful careers in corporations. Many people find that angels provide not just money, but a lot of great advice. And I go into much more detail in the report about that, but it is one of the big benefits of working with angels is the advice that they give. And I know that there was a screening process that helped, that Circle Up helped with, and I can't describe that. I actually don't remember it that well. But there was a screening done by Circle Up, which identified up front the types of people that would be more aligned with good, clean, with Wendy's with Wendy's values.
That's interesting. Okay, a question here from Michael. He's asking, does a crowdfunding platform take care of everything to the point that founders would not need an attorney? If not, what does a founder need an attorney for if a crowdfunding platform is used?
So I'm not aware of any crowdfunding platform doing all the legal contracts. So I mentioned a term sheet. That term sheet, and actually maybe some platforms may do that. I don't know off the top of my head. I'm not aware of any particular crowdfunding platform that does that. So you still need a lawyer to review your term sheet. So you, to save money, may decide that you're going to draft your term sheet, and in the report there's a link to to a sample term sheet so that you can start to think it through. So ways of saving money with your lawyer might be that you think your term sheet through with your investor, but your lawyer reviews it.
Okay. Great, thank you. And then we have it's more of a comment than a question, but I'll just put it out there in case you have any reaction, and I have a little reaction. Eric just commented that reward-based crowdfunding, the monies committed are not tax-free. They're considered income and taxed as such. Do you have any comment to that?
Well, I would agree with that, and I
Yeah.
think, Erica, you two do.
Yeah, absolutely. And I was going to say, I think this also goes back to, well, it kind of piggybacks off of Michael's question about involving a lawyer, and goes back to what you said, Jerry, earlier about working with lawyers and finance support firms like ours that understand crowdfunding so that they can understand the tax implications, or understand, how you need to review that term sheet, or all those things this is things that they have done. So I would just agree as well.
Great.
Okay, and we have a bunch, also just a little plug. Jerry has tons of great content on her site that goes into the nitty gritty of these sorts of
So
things.
I can't hear you anymore?
Oh, I'm here. Can you hear me? Hello?
Okay, yep, now I can.
Okay. Phew, that was a close call.
Sorry about that.
No, that's okay. I was just saying that we have a post about sort of the tax implications of crowdfunding that's on our website. So if people are interested, they can check that out. And Jerry has a ton of really useful content as well that you might want to check out after this presentation. And sorry, one more comment before we move on. Someone is asking again if there's going to be copies of the slide deck, and the answer is yes. You're going to receive a follow-up email tomorrow with this recording, as well as the deck. Okay, so that's all we have here, so I will let you move on.
Okay, so Erica, what I'll ask you to do is actually include the link. So in the list of, if you want to include the link to your
Okay.
that you just mentioned.
Okay, that sounds great. Will do.
Okay, terrific. So equity crowdfunding pointers, and actually some of these are, or most of these are true for rewards-based also, is build your network before you need it. And most of the people that are going to invest in you are going to be first and second degree connections. Very rarely does your campaign go viral, so you want to build those relationships before, and in the report I give lots of ways of building those relationships beforehand. Get organized. One of the things that I found was I did very targeted email, very effective for me. Every time I needed to do a targeted email, I had never tagged my contacts in the way that I was using them. I had to do the list manually and put it into an Excel spreadsheet. So getting that organizational structure up front, I highly advise. Clean, clear communication to get the MBA speakies, the mumbo jumbo, technobabble. You want plain English. Focus on solving a pain point, because really, if it's a nice to have, your investors aren't, potential investors aren't really going to care about it. Again, emphasize the skills of the team. This is probably one of the most important things. People, especially at the early stage, invest team more than the idea. So there is an understanding, especially among professional angel investors, that you're going to be morphing the idea over time. A compelling video, and it's too soon to have stats on how important a video is. In the equity crowdfunding arena, there are some, the stats vary in the rewards based, but I think it is a very good way of getting your point across. No more than 2 to 3 minutes. The video that I used, I think, was more like 1.5 minutes, but it is very effective, and I would highly recommend looking at the videos of even the reward-based campaigns that I included in the deck. emphasize traction. So whether you have customers, partners, media mentions, every time you email, even if it's to people that have already contributed to you or invested in you, you want to tell them, who else has come on board, and you want to tell potential investors who haven't yet invested in you, who in the interim between this email or this contact or social media message has come on board. And showing that momentum is really important. One thing that I don't have up here is people actually look at the list of investors. So having a notable investor is very important as well, and can trigger other people to invest in you. Reach out often and use multiple ways of communicating. So I am a writer, and I wrote in Forbes, I wrote in Triple Pundit, I wrote on LinkedIn, I emailed regularly, I did tons of social media tweets, I was on Facebook, I even experimented with Pinterest, which didn't work for me, and I would recommend not experimenting with a new social medium. So build your social media platforms out before you start your crowdfunding campaign. This I think is really important, and I found myself getting my hurt feelings when people that I thought would contribute to my campaign didn't. You know what? It's not personal. Maybe they didn't read your email. Maybe that day they were in a bad mood. Don't take it personally. Just move on and just keep on going. So look at it as a numbers game, not personally. And very important to attend to details. So what are the skills that I think are critical to a good campaign? It's being organized and a good marketer, a storyteller, again, clear communications. This I thought was really, really interesting, and I only interviewed 4 angels who have done equity crowdfunding investing, so I don't know that this is a full trend, but the 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 thing that I'm hearing more from angels is that they prefer realistic projections over the type of bravado projections that VCs like. And I don't know if that's consistent yet, and I would love to hear from other people on that topic. And I mean, in my future interviews, I may start delving into that a little bit more. And again, aligning words with campaigns, you're going to be delayed on your production runs. So you know what? Just keep people in the loop. Stuff happens. People understand. Pebbles, which did its first raise, I think they were trying to, I can't remember how much they were trying to raise. They ended up raising $10 million, and it exhausted their manufacturing capabilities, and it took them way, way longer to produce the watches, but they eventually did. And by keeping people in the loop, yeah, people were annoyed, but not to the degree where they wouldn't buy the watch again. So they did a follow-up campaign just a few months ago and were able to raise $20 million. So I'm not going to pause here because we're running out of time. I'll take all the questions at the end. I think it's very important to understand what an investor looks for. So earlier on, I got a question about, will you be building a relationship with your investor? And yes, it's not just about profit. It is about profit, but it is more than that. Many people want to roll up their sleeves and help an entrepreneur succeed. It is about giving back. They want to participate actively. And one of the reasons that so many women are getting involved in angel investing right now is because they want to get on boards, and so few women are on boards. So why are angels using crowdfunding platforms, so the 4 angels that I interviewed, it is about increased deal flow and quality deal flow, so rated deals. Most of the platforms only accept a very, very small percentage of deals that they look at on the platform. So, it's centralized and convenient, it's transparent, everybody sees all of the same information, it's streamlined, it saves time, you can do it whenever you want in the middle of the night if that's your time to do it, and they really like learning from other people. So let's just move on to the final questions.
Great. And for those of you with quick eyes, you'll see that Jerry just quickly skipped over resources. But again, when we send out this deck to you all, I would recommend that you sort through those resources and find things that are of use to you. Okay. First of all, I just wanted to comment on something that you said about angels seeming to be the trend is more interested in realistic projections. And just anecdotally, we see this with our clients that you certainly need to provide those pie in the sky top-down projections when you're pitching to venture capitalists, because they want to see the glory that could be theirs. But I think they also do like those realistic projections as well. And so that's why we say you should always do the bottom up as well as the top down projection to give that more realistic what you can really expect. So I just wanted to add that. So Alan had a question about when you said, good follow-up. He wants to know specifically, how often should you communicate to your investors?
So you may make an agreement with your investors that maybe it's a regular communication on a monthly or quarterly basis. That can be part of the discussion you have with your investors. But while you're doing the crowdfunding campaign, you may want to keep them in the loop as to how well you're doing. I'm trying to remember how often I did it. So I may have done it, if you gave me money, I may have done it maybe 2 or 3 times during the month that I was raising money. So once you gave me money, you went on to a different list, and I did not nag you to the degree that I would have nagged you if you didn't give me money. But I certainly kept you, so on a periodic basis, I let people know how close to the goal I was. And the purpose of that is that somebody might actually recommend to somebody that they know that they should invest, and based on the momentum that you're building. So momentum is very important. So even before you go online, you want to have people who are already committed to giving you money.
Right. Okay, and this is kind of a related question from Yun here. She's asking, how long does the average crowdfunding campaign last? Is there a best practice recommendation for length of the campaign?
So right now, according to Crowdnetic statistics, so they're a database of about 18 crowdfunding platforms, it's averaging about 4 months. I think everybody thinks that as people get better at it, it will drop. And as I said, I think that and I may not be remembering this correctly, but I think the average for an offline investment would be more like 6 to 12 months and beyond.
Mm-hmm. Okay. So someone's requesting, while we're answering questions, if you wouldn't mind, can you just flip up back to that resource slide? They wanted to eyeball it while we're taking questions. Great, thanks. Okay, Jerry wants to know, how do you set your goal? And then his follow-up is, and what if you don't hit your goal?
Okay, so hopefully you're working with your accountant on this.
Agreed, yes.
And I go into, yes. I do go into more detail in the report, but again, you're covering your expenses for a period of time until you think cash flow is going to cover your costs, or until you do the next raise. So you're, doing a budget. You're doing a budget, for probably 3 years. The first year would be on a monthly basis, and you're figuring out what all of your costs are, what all of your expenses are, and when you think revenues are going to kick in and cover the expenses that you have, and you'll be at break even.
Okay, great. And then Naina's just asking, you keep referencing your report. Are we going to send it in the follow-up email tomorrow, or might it make more sense for you to send that in a separate email to everyone who's on this?
So all you need to do is click on the standout in the crowd, how women and men benefit from equity crowdfunding. So that's the report. It's free, or not completely free. You're going to have to give me your email address.
Okay. Okay, great. So we'll include that link in the follow-up email for those of you who are asking the question. So you just click on that, enter your email address, which we've already given us, and then you'll have access to that report. Great. I think that answers all the questions we have right now. Maybe I think your contact information is on that last slide, Jerry, if you want to just have it up. Sorry, someone's saying the hyperlink doesn't appear to work. Yeah, it's not that link's not going to work right now while you're looking at the deck through GoToWebinar, but when you get the deck or the follow-up email, then you will have a live link that works. So yeah, unfortunately, it's not interactive when you're watching this presentation. Great. So you all can see Jerry's provided her contact information here. So if you do wind up having any follow-up questions, please feel free to reach out to her and check out all those resources we're going to be sending you tomorrow. And we're getting some nice feedback from people saying, great presentation. So thank you so much, Jerry, for your time. We really appreciate it. I thought this was really helpful as well, and I'm glad that you all did too. A quick plug for us. We have another webinar coming up on August 31st is our next one, and that is going to be Get Noticed with the Ultimate Startup Pitch Deck with Mark Phillips from Arafura Ventures and Gadiel Morantes, who's a partner here with Early Growth Financial Services. So if that sounds like something you'd be interested in, please check out our events page to sign up for that one and check out other upcoming webinars. And Jerry, we may have to have you back in the fall after Title III has finally come out to revisit. Yes, wonderful. Okay, thanks again. Thank you so much, Jerry. Really appreciate it. Thanks all for joining.
Okay, terrific. Take care.
Bye-bye.
Bye.